Hi, everybody. I see people starting to trickle in now. My name is Mike Langford. I'm going to be moderating today's webinar. As we let people continue to fill in here, we're just going to kind of be in a little bit of a holding pattern for another 2 minutes or so. One of the things that I'll suggest to you, and you'll hear me say this a couple more times, is feel free, if you've got some questions that you came prepared with some topics or questions that you'd hoped that would be covered, make sure you make a note of those. You can fire those questions in anytime in the right-hand panel. There, you'll see down about midway, you'll see something that says questions underneath webcam. So go ahead and fire those questions in. I'll be kind of moderating those and making notes of them throughout the webinar experience. Yeah, so hey, by the way, while I have you, if you're just hanging out, we have at Truelytics launched a new podcast called Valuations, and it's covering a lot of the topics that we are featuring here in the webinar. So if you'd like to subscribe to that podcast and check it out, you can head over to truelytics.com, or you can head to iTunes or Stitcher or SoundCloud, wherever you like to get your podcasting on. Okay, so another minute or so, and we will dive right in. Kind of feel like we need waiting music. I should have brought waiting music. That is the awkward part about doing a podcast, by the way. I can't see all of you laughing. I just assume that everybody got a little bit of a chuckle out of that waiting music joke, just so you know. Carla is.
I did unmute momentarily. I was going to laugh. You know me too well, Mike.
I know you. Okay, we'll give it one more minute. It is officially 1 p.m. Central Time, 2 p.m. Eastern Time. We'll give it one more minute because if anybody is like me, anytime you go to log into a webinar, that is the time that your computer acts up. And actually, as we were rehearsing this webinar, that happened to me, and I had to jump on another machine to do this. So I know the pain of opening up a webinar and trying to get all logged in and get everything situated. So we will give you another 30 seconds or so, and then we'll dive right in. Okay, we'll get started now. Well, welcome to the Market Update webinar. I'm really thrilled to have you here joining us. Today's webinar, as you can kind of see from the title slide here, is brought to you by Truelytics and Live Oak Bank. To give you a little bit of a background, Truelytics is the premier business intelligence platform for the wealth management industry. Thousands of individual advisors and wealth management firms are already relying on Truelytics for valuation, succession planning, and many other actionable business insights. Joining us today from Truelytics is Carla McCabe. She's the Director of Practice Management there at Truelytics. And on the Live Oak side, Live Oak Bank has a robust history of serving the investment advisory industry with a myriad of banking solutions for operations, expansion, and of course, acquisitions. And in fact, they specialize in acquisition financing across a wide variety of industries, including the investment advisory business. And with us today from Live Oak is James Hughes. He's a loan officer who specializes in the investment advisory industry. And just a quick note before we get started, as I mentioned, for some of you who are coming in, we want this to be interactive and engaging for you. So please do enter your questions using the question form. If you look on the right-hand side, down about halfway there, you'll see a little thing that says questions. You can click on that and get in there. You could ask any questions you want for Carla and James, or just more generally, and whoever feels more appropriate will pick that question up. You are going to be muted throughout the presentation. So texting, putting the questions in text is the best way to do it, because we just can't let the microphones run wild. All right. So now I'll turn it over to Carla and James. Take it away.
Thanks, Mike. And James, thanks for joining us today. We're thrilled to have you and hear some of your insights and thoughts about what's going on in the industry. So let's start with you guys. And again, James and I want to run through this kind of quickly because we want to open it up to you for your thoughts, questions, comments, etc. So quick state of the industry statistics right now. Average age is about 57 years old. This is based upon our data here at Truelytics. I was thinking today that this data might actually, the actual number might be a little bit higher, given the fact that some of those older advisors probably aren't filling out the industry surveys or using technology like Truelytics. So 57, maybe 59, a little bit older. Vast majority of the industry is lacking a interim continuity plan. That's your death and disability plan. 84%, in fact, of firm owners don't have that plan in place. 52% of the firms out there are lacking a formal operating agreement to run the business and to dictate, hey, this is what I want to have happen under these scenarios: death, disability, retirement. 73% of firms are lacking proper employee retention mechanisms. So if there is a triggering event, there's very little in place to retain the rest of the staff should that firm transition. And only 13% of owners have actually started the long-term planning for their eventual retirement or sale or transition of the business. These are pretty startling facts. All of these altogether obviously are really driving a lot of M&A that we're seeing in the industry right now and a lot of the conversations that we're having. More on the state of the industry, practice management and transferable value. Advisors really need help running their practice and building that transferable value, because ultimately that's what you're going to transition. Back office efficiency is a key challenge today. In tandem with that, margin compressions. Your expenses are fixed, your revenues are variable, and we all know that there's probably going to be a market correction in the next 18 to 24 months, and that is probably going to make things a lot harder in this instance in running firms and watching those margins. Profitability, therefore, is a major issue. You know, added fixed costs around new regulations, the compliance that's being demanded of this industry, and evolving technology costs. Those expenses keep going up and up, making it more and more difficult for owners to run profitable businesses. And lastly, valuation. What ties all of this together is that the traditional valuation methodologies that a lot of you hear out there in the industry are really not accurately reflective of what firms are really valued at. We're going to touch on this in a little bit, actually, and myths and realities around that valuation. I'm sure all of you have heard, you know, firms are valued as a multiple of revenue. Unfortunately, that approach is really the least accurate and, quite honestly, the least accepted method. The other big thing that everybody hears about is, hey, you know, my firm's worth X, because that's a standard multiple. We here at Truelytics say that, you know, there really are no standard multiples. They're kind of rule of thumb, they're guidelines. But I want you to kind of throw all of that out the window, everything that you've heard before about multiples and multiples of revenue in particular. Another challenging myth out there that, you know, my valuation is what my practice is going to sell for. Quite honestly, that's not really the truth. And it might be, but your valuation is really only a baseline. It's a guideline. It's a starting point. Valuation measures your intrinsic value, not necessarily your fair value, what a particular buyer might pay for it. And honestly, most sophisticated buyers are going to determine their price based upon their expected return on their investment. A buyer wants to see somewhere between 12 to 15% on that purchase that they're going to make when they acquire a practice. And honestly, quite simply, they're going to back into a multiple to make a seller feel good, which feeds into those first two myths that we just talked about as well. Big one, we talked about earlier, that lack of interim continuity planning. 84% are missing it. You know, unfortunately, should there be a triggering event like a death or a permanent disability, your firm's value is going to erode immediately, roughly about 60% pretty quickly after that triggering event. So the folks that don't have an interim continuity plan in place, unfortunately, you're not going to realize full value for your firm when something happens. So again, all of these kind of tie to what James and I are seeing out there in the market, that increased demand for conversations around mergers, acquisitions, succession planning. James is going to tell us what he sees on his side of the industry now.
Thanks, Carla, and thanks for having me. Really appreciate the opportunity, and for all of those that are on the webinar, appreciate you taking time out of your busy day to hear what we have to say. I'll sort of reiterate what Carla stated is, we're going to try and move through the next, I only have 4 slides here, and that's on purpose because we really want to talk about what you guys have questions on. But just briefly, I'll go through sort of a few things, sort of where I see the market today. So, first thing, where do we see industry values? We continue to see transactional value or commission revenue decline in value, and recurring revenue has really held steady in terms of value. We see some firms have actually started to value recurring revenue as increase since 2017. So continue to see strong value for the recurring revenue. The other thing is that we see larger down payments becoming more common. As I'll show you in a couple slides, the difference between before bank financing and now after bank financing, or now that bank financing is prevalent, down payments have definitely increased, and we continue to see that. So as I sort of shift to the right side of this slide, where we see the market is definitely a seller's market. There are few sellers and many buyers, and that sort of ties into that larger down payment component I just mentioned. Sellers are really dictating the terms of these transactions, and because of that, they're demanding a larger down payment. This ratio here of 40 interested buyers, it's really, you hear all sorts of numbers from 40 to 50 to 60 to 100 to 1 in terms of buyers to sellers, but really, the average deal has, I think it's 3.5 or 4 offers for every 1 book being sold. So of the interested buyers out there, there's really only 4 qualified. So if you're somebody that's interested in acquiring a book, your goal is really to get from that vast number of interested buyers down to the few qualified buyers. So that's something that we can help you achieve. And just the last thing that we're seeing is buyers becoming a lot more aware of acquisitions as a great way to grow your business inorganically, more aware of financing as an option, more aware of where valuations are today, and just in general, more aware and more educated. All right, so one question we get all the time is, how do I ensure that I get the most for my business if I'm a seller? What are premiums being paid for? What components of a book are being valued the highest? So growth potential. So whether or not the book is growing organically through referrals or truly or organically year over year, if a book is growing organically, then a buyer would be willing to pay a premium for the book. Now take the flip side of that. If the book is stagnant or is actually losing clients, then a buyer would look to potentially pay a discount for that book because the value is continuing to decline. Profitability is going to be the number one factor in my eyes. As a banker, that's the number one thing I focus on, is the profitability of a book. And as Carla sort of uniquely talked about her different thoughts around valuation and what buyers look for on the ROI of a book, I think that is really good perspective. And a lot of it is going to always come back to the profitability of the business. How profitable the business is will really drive the value and can command a premium in the market. As we mentioned on the last slide, recurring revenue really being held up highly as far as value. 100% recurring is going to command a premium. Large national custodian or broker dealer, that's going to command a premium. So these last 2 points here, turnkey operation. What's meant by this is, how easy is it for a buyer to come in and take over your book and it run just the way it was before? So there's a lot that plays into this. Workflows, processes, staffing, the investment management of the book. So all of those are factors, and if there's anything there that is sort of tied specifically to the seller, that only the seller can currently manage that, and it's going to be difficult for a buyer to come in and take over that process. then a buyer is not going to want to pay a premium for that business. Versus if a buyer can come in and everything sort of runs smoothly from day one, then a buyer is going to want to pay a premium. The last point I'll make on this slide is contingencies. So contingencies or clawbacks, there's several names for it, but some protection for the buyer is what is meant by that, where some component of the purchase price is held to, there's some sort of clawback, where if it's $1 million purchase price, there's some guaranteed portion, say half of it's guaranteed, and then the other half is going to be contingent based on the performance of the book. If the seller is willing to provide contingencies in a deal, then the buyer would be willing to pay a premium. All right, so the next two slides, I just want to very quickly go over the way structures, the way purchases used to be structured and the way they're being structured now. So this first structure here is sort of the historical model where deals are being done mainly with earnouts. And so the first thing you'll notice on the screen is that there's a risk meter, and the risk meter is currently all the way to the seller. So in these deals where the majority of the purchase was financed through an earnout, the seller is taking on most of the risk. So the buyer would do a small down payment, 10, 20, maybe sometimes 30% of the purchase in cash, and then the remainder was held by the seller in an earnout. And a couple things happen here. So the seller's taking on most of the risk. They're only monetizing 30% of the business today. And through that, the seller is a lot more involved with the business because of that. They're waiting for 70% of the value to come to them, and therefore they're very involved in the business and concerned with when they're going to get the rest of their payout. The other portion is that the earnouts are typically over 3 to 5 years. So the term that the buyer has to pay back is very short, and therefore the purchases historically were actually not cash flow positive. The buyers would sometimes be losing money on the acquisition until after the seller was paid off. So now if we look at the way these deals are being done today with bank financing, as you see, that risk meter has really shifted over to the buyer as down payments have gotten higher. So with down payments increasing, we're seeing sometimes 100% of the purchase price is paid up front. That is somewhat rare, but larger and larger down payments, the buyer is taking on a lot more risk. So from the seller side, the seller is able to monetize more of the book value on day one, and therefore the seller is less involved. We're out of the business more quickly. And from the buyer standpoint, we're seeing discounted purchase prices for the larger down payments, especially when it's 100% of the purchase price on day one. And there's a 10-year term associated with our notes, and therefore the buyers are actually cash flow positive on these transactions from day one. All right, so those are the things I just wanted to touch on briefly, and I'll I guess pass it back to Mike and maybe open it up for questions.
Well, thank you very much, James and Carla, of course. That was fantastic. Great job from both of you. Really, really informative. We've got a few questions that came in that are teed up. And by the way, like I said, if you have questions, go right to the right-hand side of your screen. There is a question panel there. You just click it and you'll be able to type your question in. If for some reason that's not working, there's also a chat feature there. For some reason you can't get a question in and you're struggling with the tech, you just shoot it over via the chat feature. We'll make sure it gets answered. But a couple of questions that came in. One of the first one was a little from earlier in the presentation. What makes someone a qualified buyer? You used the phrase qualified buyer there. How do you define a qualified buyer in this market?
That's a great question. A qualified buyer is somebody that, first of all, is typically an investment advisor. An independent advisor, we like to see transactions where a buyer is buying a business that is a like size or smaller than their book. We do look at transactions where an advisor is buying a larger book, but most of the deals, it's somebody that's looking to buy a book that's the same size or smaller. And the last point I'll say is that qualified buyers are going to be financeable. So really, what in general makes a qualified buyer is they're going to have the capacity to acquire a book of business. And that's sort of a loaded statement in that there's a lot that goes into understanding the capacity of an advisor, and that's the staffing, the processes, their business today, how smoothly it's run. A lot of these acquisitions, people are doubling the size of their business. So if you think about, if you have 100 clients today, dropping in another 100 clients into your business, are you going to be able to do that and still run your business smoothly? And then again, as I mentioned, being financeable, having strong financials, both with your business and then also personally.
That's great.
I'd love to add to this, James, because we always joke that when we speak at an event around M&A, we'll ask the room, a room full of 100 people, how many of you want to do an acquisition? And 99 people will raise their hand. That last hand does not go up because the guy's kind of zoned out or fallen asleep. But to your point earlier, out of that 100 or so people that want to buy, that want to acquire, very few of them actually are qualified. I think the really important thing to remember when you're a buyer is that any seller that you're talking to, they're going to be exchanging their risk as an owner running that business for your risk as an owner. So it really means taking a hard look at yourself and, am I making this seller feel good about my ability to pay him back, to run his business correctly, to take care of my clients, etc. There's so much more that goes into it. I always encourage people that are, contemplating an acquisition to really do a really honest SWOT assessment of themselves first, whether they're qualified to really be purchasing and more importantly, like you said, James, integrating that practice post-acquisition.
That's great. We do have another question that just came in from Don. Don is asking, do you have a white paper with sample deal terms options included in the white paper?
I do, yeah. I would encourage people to reach out to me directly. I'm sure we can share our information to the audience, and I can definitely share that with you.
Great.
I'll just add, because you have it up here, but we have a resource center on our website. It's our knowledge bank, and there's a ton of white papers and calculators and all sorts of stuff up there.
Oh, that's fantastic. That's very helpful. And there's also, I know, Carla, you'd echo this. There's a lot of white papers and resources also on the Truelytics site as well that you can access that may be helpful in that process, Don. So Dorothy is asking, what is the maximum % of the business sale price that Live Oak will finance? Is this an SBA loan or something else, she says?
Great question. So we will finance up to 100% of the purchase price. We always want our buyers to be protected. So if they're looking to write the seller a check and that really be the end of it, then we would really expect or want to see a discount on the book. So the valuation says $2 million. We would want the purchase price to be under $2 million. We also offer a product where we do a escrow account where you borrow 100% of the purchase price, but you only give a portion to the seller on day one and put a portion into an escrow account for a period of 12 months, 6 to 12 months, and it's released from the escrow based on the performance of the book. So you're borrowing 100%, but you're not necessarily giving everything to the seller on day one, so the seller has some skin in the game. And just to answer the other part of that question, We offer SBA and conventional financing. So it really depends on, the type of deal that we're looking at and whether or not, the buyer wants SBA or they want conventional, but we definitely offer both.
Very nice. We have another question coming in. This one's from Celeste. And Celeste, I'm not sure if this is a question. I assume it's a question for Truelytics, but if you meant it more for Live Oak, please do let me know. She asks, how do we get a demo of the tool to determine which data inputs are needed to determine a valuation? So it's probably how do we get a demo of Truelytics, I would assume, Celeste?
Yeah, well, I would be happy to help with that. My email address, if you want to reach out, you can always schedule something through our website too, at truelytics.com, or my email address is Carla with a C, C-A-R-L-A at truelytics.com. Happy to set you up with a demo and go from there.
That's awesome. Very cool. Let's take a look here. We have another question here, and this one's interesting to me, and it kind of builds on one of the things that you said, James. The question is, what's going to happen in the age, as the age of advisors, excuse me, what is going to happen as the age of advisors and owners continues to rise? Who's going to buy all these firms? And what I think that's related to, James, is you mentioned that it's a seller's market, and I found that really interesting because we've had a lot of conversations with the Truelytics team that if the buyer is more in the driver's seat, right? Because the buyer has a lot of choices, and as the population of advisors age, that's going to affect, supply and demand type deal. So really, really interested in your perspective on this. What's going to happen as we see, the average age of advisor now is already over 50. What happens when it climbs to 60 and so forth?
Yeah, I mean, we say that it's a seller's market because, the buyers, at least the deals that I've seen, right? So, and to give you an idea, last year we did 120 book purchases. And, that doesn't include all the ones that we looked at and didn't end up doing. But so it's a seller's market because, anytime, the majority of the deals that we see, there's at least, 3 offers on the table, right? So if a seller says, I want 80% up front and 20% in 12 months, and one of the buyers says, well, I don't want to do that, then they just say, okay, great, I'll move on to the next buyer. So sort of adding to that, as the average ages of the advisor, continues to increase, I think the real answer is we have, no idea on how it's going to transpire. But, what we would think happens is that, so right now we have a supply and demand issue where there's a limited supply and a really high demand, high demand for buying books and a limited supply of sellers. So as the sellers increase, you would think that the demand would fall, and maybe valuations come down. Maybe the terms start to get a little bit more favorable for the buyer. Down payments come down, but based on the appetite for acquisitions today, I would actually think that the demand stays constant. Because the folks that are out there acquiring and doing it well are going to continue to acquire, and they're going to get larger and larger and larger. They're going to continue to acquire, while the smaller advisor still has the appetite to buy. So I just think that we'll see a larger supply, but I do think demand will sort of stay steady, and therefore valuations, I think, will also stay steady.
Very
interesting. I think you're right. I agree with you, James. I think there's going to continue to be that collapse up, if you will, within the industry. The one thing that I'm a little concerned about, that it'll be interesting to see how it plays out, is obviously there's such a lack of young talent coming into this space. With that owner age continuing to rise, and we do see that people are hanging on to their businesses a lot longer, a lot older in their lives. I work with advisors in their 70s and 80s even that are reluctant to sell. My thought is, what happens, if somebody finally decides at age 75 or 78 that they want to sell their business? Yes, there's going to be buyers, But you got to think about the demographics of that book of business at that point. Typically, your clients are within 5 years of your own age, plus or minus. So that gives us a really old client base that we're going to try to transition at that point. And you have to wonder if you're a buyer looking at that book, are you really purchasing a depreciating asset? If more money is going out the door in distributions based on those older client ages than is coming in, it'll be interesting to see if there's going to be a drop in valuations over the next decade or so to kind of allow for that factor.
It's, staying on this topic here, Drew asked a question, kind of a follow up on the seller's market question. He says asks for the sales that you're participating in at Live Oak, how are the successful buyers differentiating themselves? So what are you seeing? How do people stand out if they're looking to buy a business?
Yeah, I think people that are prepared and educated, and so I mean we could spend a lot of time on that. I typically say the same thing that Carla said earlier, where I go into a room, I'll probably do 50 presentations this year, and say how many people want to buy a book. They all raise their hand, and maybe 2% of them actually transact in the next 18 months. And I think that two things that people either do well, that do a lot of acquisitions and are successful, or don't do well and therefore they're not successful at it, is preparing your business for an acquisition. So that's going to be, again, as we talked about earlier, processes, workflows, staffing, a strong financial bottom line to be able to qualify for financing. And then the other thing is sourcing sellers. So, finding sellers and actually being able to be a part of, the 40 or 50 interested buyers and ultimately get chosen as one of the qualified buyers. The people that do it really well, obviously, take this very seriously, and it's an important part of growing their business. So they're constantly looking for new opportunities. And then their approach to the seller has really been refined in, talking to the seller about what their goals are and finding a structure that works for them. So whether it's a recruitment deal, it's a merger, or it is a buyout, they find a way to sort of capture the seller and do some sort of transaction with them. And just the last point I'll make is I think that they are set themselves apart by being a serious qualified buyer, by having conversations with Live Oak Bank and going to the seller and saying, listen, I've had a conversation with Live Oak Bank. I like your business. I like you. We're a good match. I know that through my conversation with Live Oak, we can close on this deal in 2 months. I'm ready to go. And by sort of proving that you're educated and that you're serious and that you're qualified, you're going to set yourself apart from the other buyers.
Excellent.
I'm going to echo what James said too. Being really clear on what your motivator is for wanting to do an acquisition, and be very clear on what objectives you're trying to accomplish. Oftentimes I speak with folks that really just want to do an acquisition for the sake of doing an acquisition. And typically that leads to not being successful in that endeavor. So get very clear about, do I want to just gain assets? Am I trying to look for younger talent? Am I looking for geographic outreach to expand my client base? Am I looking for technology? Maybe you're looking for, a succession plan. That's why you're doing an acquisition, but become very, very clear on that. And don't make the mistake either. An acquisition is not to be intended to make up for the lack of organic growth. In other words, if you're not able to grow your business organically, you probably shouldn't be going out to do an acquisition. And then lastly, working with firms, doing an acquisition becomes a full-time job when you're looking for someone. I kind of joke that it's almost like dating and marriage. You're going to kiss a lot of frogs. It's a process. You're not going to marry the first girl that comes along, and nor should you be acquiring the first book necessarily that comes along. It's being very smart. It's being very process driven and taking a lot of the emotion out of it, and not just try to get a deal done, get an acquisition done, but make sure that you're doing it for the right reasons.
It's great advice. Okay, so we have some more questions coming in. We have a couple more from Celeste here. First question, I think we covered this a little bit earlier, but maybe we need a little more clarity on this. She asked, what's the average percentage of an acquisition / the loan that is based on contingency?
Oh, okay, yeah. I would say that the average is probably 25%, where we're doing a down payment of 75%, and then there's 25% in a seller note, and all of that is contingent. Or we would do 100% financing, give the seller 75% on day one, and put 25% into escrow, and all of that is contingent. We have sometimes seen 50% down payments and 50% contingent, but I would say that the average is 25%.
Celeste has another question here about privacy. So how does an advisor handle privacy issues if I'm buying a practice from an advisor with another broker dealer? So I'm not sure what the privacy concern there is, but maybe if you feel this is in your wheelhouse, what are some general privacy concerns and ways that they're handled during these transaction processes?
Absolutely. So we so we are 100% confidential, so we don't share any information with anybody that asks, really. So we have handled typically our conversation is with the buyer. So the buyer comes to us and provides the financial information, and then we'll provide the seller's information as well. Sometimes the seller doesn't want to provide the information directly to the buyer. We have secure drop boxes that buyer or seller can use. Our website is completely secure, and we're we have the Bank Secrecy Act. We're not allowed to share information to others, so it's completely confidential.
All right, great.
Before you get to the financing part, if you're either a buyer or a seller and you're entering any type of conversation beyond, hey, I might want to buy or I want to sell, I highly encourage you to put a non-disclosure agreement into place before the exchange of any type of information. And really trust your gut as you go through that process. Again, just like dating and marriage, do your due diligence on people. Again, it's a process. You're going to take baby steps. If you're the buyer and you're talking to a seller, realize it's a very emotional process for them, and you kind of got to gradually ease them into that conversation and the release of the information about their business over time.
Yeah, and I would add on to that, if I may, one thing that the seller is going to be most nervous about, if you will, is letting you see their client roster, right? Because that is the value in the business, right? It's you're buying relationships when you're acquiring a book of business, and so any ability to see who those relationships are kind of puts a risk in play for the seller, right? That you might just pick off those relationships without paying for them. So that's where they're going to be probably the most squirrely from a privacy perspective. We have another question coming in from Jeff. Jeff asks, are fixed rate loans available to the buyer, or are most of the loans variable in nature?
We offer both fixed and variable. Over the years, there's a spread between what we offer on the variable and fixed. Variable is lower than the fixed. The majority of our portfolio is variable, but we have always offered both variable and fixed.
Great. Let's see. Going down some of these other questions that came in. Want to make sure we get spread it out a little bit. Here's a good one. How do I go about finding a seller or a buyer? Right? What are the resources that are available, and who can help with finding a deal?
Oh goodness, I'm asked that question every single day, I think. Networking, if you want to kind of do it on your own, networking is the best way. People often think that I'm going to make the decision to go out and do an acquisition. I'll find somebody next week. They don't realize that it's actually a much more time-intensive process than it really is. Again, you're going to be kissing a lot of frogs. I think United Capital a couple of years ago, I spoke at an event with one of their folks, and they said that they had looked at 200 potential acquisitions in the previous year. They ended up doing 2 deals of those 200 conversations, just to put things in a perspective for people. So attend as many events as you can, join groups, do it through LinkedIn, your national conference. If you're part of a broker dealer or a custodian, just start having conversations with people. Talk to your wholesalers if you work with any. Just kind of put the word out there that you're looking. I also say, if I'm a buyer, I might not necessarily want to look for a firm that has a for sale sign on their front yard, so to speak. Usually when you come across that person that is like, yep, I'm ready to sell, here's my for sale sign, this is what I want, you got to be very careful of what you're getting yourself into. Quite often the best opportunities kind of just present themselves through conversations where you realize you're doing the same thing as someone else, you realize there might be some synergies, you start thinking about a combination, and sometime later you're actually in that conversation of figuring out how to make it work. There are groups out there that can be resources to help you find these opportunities. The success rate of them is largely undetermined, just from conversations I've had. Truelytics obviously can be a resource to help you with that. In the future, we are building a marketplace that's going to be a phenomenal resource, probably first or second quarter of next year.
Very interesting. Very good. Speaking of Truelytics, one of the questions that I had personally was around the topic of valuations. We're talking a lot about transactions here, about buying a business or selling a business, and I think most of the interest has been on acquisition for this call. But do both parties need a valuation, right? We talk a lot about valuation at Truelytics. Do both parties in this equation need a valuation, or is it only the seller that needs a valuation done?
I think both should. You want to be a successful acquirer, you kind of need to know where you stand. Again, that seller is going to be exchanging their risk for yours. And because it's such an emotional process, every morning that seller wakes up, he's going to be looking for a reason to say, no, I don't want to sell my baby to you. So you need to have a very understanding of the holes that he might or she might punch into your business and say, hey, I don't like the way you do this. For example, maybe you want to acquire a business, but you don't have an interim continuity plan in place for yourself. If you become disabled or die, that seller is not going to feel very secure about selling his business to you. And James, I'm sure you see, you want to look at their own firm, the acquirer's financial status before giving them a loan.
Yeah, I mean, I definitely think that, knowing in the process of acquiring a business, we don't necessarily require a valuation on the buyer, but I do think it is good practice to get a valuation done so that you understand where you are. And honestly, the tool that you guys have, I've used and gone in, acted like I had my own business and went through and you guys have some really unique things there where you can sort of go in and adjust things that within your business to see how it affects the value. And as I talked about earlier, the importance of being financeable, to be able to get a loan is extremely important in trying to be a qualified buyer and win deals. So having a valuation done can be really helpful in seeing where there's holes in your business and how you can improve not only the value of your business, but your ability to go out and acquire other businesses.
Cool. So quick question, another one from Celeste here. What are the major differences between an SBA loan and a conventional loan?
Great question. Celeste, I would be happy to talk to you offline and we can talk more about it. But so the general differences from what people mainly talk about is the SBA loan is going to be a 10-year loan with a lower interest rate. The conventional loan is going to be either a 5 or a 7-year term and likely have a higher interest rate. I'll just the conventional loan, we also require a lien on personal residences. The SBA loan does have a clause that we may require a lien on personal property, but it's not necessarily required. It is required with the conventional. But I'm happy to talk at length with Celeste afterwards. So please follow up.
Great. Along that line, how long does the financing process take? Is another question we have here.
Yeah, so it takes two months. Right now, we have a ton of requests coming in for year end and beginning of the new year. So we're actually telling people to get their stuff in this week in order to hit that time frame. But in general, 2 months is more than enough time for us to get it done.
Fantastic. Okay. This is an interesting one, and I've had a couple of conversations with the Truelytics team about this, and I know that this is a drum they beat regularly, but how does a business's valuation translate to the purchase price, excuse me? So like kind of what's the relationship between the valuation that you might have done with Truelytics and the actual purchase price when the deal is done?
Yes, this is a fun one. So again, we talked about it really early on that the myth that, hey, my valuation is what my business is going to sell for, which unfortunately is very seldom or very rarely the case. So your business valuation done through Truelytics or any other provider is merely trying to assign an intrinsic value to your business. You know, what does my firm look like as it stands today? It's kind of a health metric. It's, you know, going to the doctor's office and getting a physical done with your blood pressure and getting your cholesterol levels checked. So how that translates to what the business would be worth in a transaction, remember, every buyer and every seller is going to have their own objectives that they're trying to accomplish. So somebody's going to come in, they're going to look at their business. You know, for example, the one that we have up on the screen, this business, the intrinsic value is $2.22 million. So that's the intrinsic value, what it would be look like just off the street compared to anybody. So I might come in and look at this business and say, all right, you know, there's no infrastructure in place. There's no technology in place. There's very little staff that would be of service to me in the future, or the client demographics are really old. So I don't want to pay $2.2 million. Maybe I only want to pay $1.9 million for that. Conversely, I could look at this business and say, wow, they've really got some young talent. It gets me into a new geographic area. They've got some complementary business lines that I want to add. Maybe they do tax planning. I see a premium. I see something in that business that I might be willing to pay a little bit more for. I might pay $2.5 million. So that difference in price there, so that is the fair value. And that fair value is buyer specific. So while this $2.2 million gives you the good baseline, you know, again, every buyer is going to come in that has a different objective, a different return on their investment that they're looking to meet. So it really just becomes, you know, looking under the hood of the business, if you will. It's conversations, it's negotiation, and it's really tied to the objectives of both parties.
I'll just add one thing here. I think that, you know, the valuation is, as Carla, you know, sort of talked about, that's the, you know, the fair market value of the business. And, you know, just from a sheer numbers standpoint, you know, being the banker in the room, I'll talk about that. I think that, you know, again, let's talk about this one. It's $2.2 million. So if a buyer comes to the seller and says, I'll write you a check, you know, right now for your business, but it's going to be 1.5 million. That would be something the seller would entertain because it's all cash and none of it, you know, there's no risk to the seller at all. So if it's going to be all cash, all up front, then you would see some sort of discount. I don't know if it would be all the way down to 1.5, but
some people are like, hey, James, I want to buy that business for 1.5.
A quick question for you, perhaps a follow-up question there, James, from your perspective as a banker, does the independent and valuation, let's call it that, right? So it's kind of like an appraisal on a house, I would assume. Does it give you comfort when you're making the loan that, hey, listen, there's a valuation here that backs up the selling price and the loan price, the loan value?
Yes, definitely. We require a valuation for any purchase above $250,000. So yeah, it definitely gives us comfort, and we require it to make sure that we're not overpaying for the business. I do just want to go back to the point about so if it's worth, valuation says it's worth 2.2, and you provide no cash down, and it's all seller financing, seller's taking on all the risk, then we would expect the purchase price to actually be above the value. So
Yep, absolutely.
uh,
So as we kind of come down to I got another one that just came. I was going to say, I've got a couple other questions that came in ahead of time that I was going to ask, but Celeste has another question here. She asked, which type of products / clients, annuities, managed assets, fee clients, and the rest, do you see are generating higher valuation? Is there a ratio of client type that seems ideal?
That's a really interesting question, and something that we're continuing to refine through the Truelytics software. So when doing evaluation, it's important to remember that what we're ultimately trying to determine is how stable, how sustainable, how reliable, and how predictable the cash flow, the future cash flow, is for that particular business. So while we're never going to try to, tell you this is how you should be investing these underlying assets, we do need to realize and acknowledge that your revenue is inherently tied to market performance. Therefore, having a good diversity amongst your portfolios is key. Somebody that's heavy in alts is typically going to have a slightly lower valuation because it's a little bit riskier. Someone who diversifies that revenue stream with financial planning or consulting or even tax preparation services that are not tied to market performance, that's going to yield generally a higher valuation when it comes to just product. But keep in mind too, though, Celeste, that everything about your firm all works together, driving that valuation. It's your business, client, and market stability. So it's each one, and we actually use 50 different key performance indicators through our software, which are non-financially driven to really view and value that firm, but they're all kind of cogs in a machine that work together. So it's taking a look at all of those in tandem with the profile of the business.
That's very interesting. What do you mean by stability, right? The client stability. You elaborate on that a little more?
Yeah, again, remember, we're trying to determine how sustainable this business is going to be going forward. So we use the discounted cash flow methodology, looking at the business the way a buyer would. As a buyer, I don't care what the revenue was or the cash flow was in 2017. I care what that cash flow is going to be going forward. So how do these different stability indicators within the business tie back into that? How stable is that client base? What's the average client age? What are the relationships that you have with the next generation of your existing clients? How are most of those coming in? Is it through existing client referrals, or is it through centers of influence or marketing efforts? So there's so many different things of how does each of one of those factors determine how stable that business is going to be going forward in relation to the cash flow that it generates.
Very good. So we only have about 8 or 9 minutes left on the session here, but I want to make sure we get a few more questions in. And if there's a couple that have been in your brain there, don't be afraid to raise your hand and ask those questions. I do have this is a fun one. I always love these ones. This one came in ahead of time. What are some of the most successful transactions you've seen? And then conversely, what are some of the least successful, I would qualify this as the horror story transactions you've seen over the years? And what are some of the shining lights and the dark spots?
Oh goodness. Well, I'm going to kick this off, James, and let me conclude. So it's really important to know this. This is a very statistic. Approximately 70% of deals will fail. And the reason that those deals fail is for a lack of cultural fit. So beyond what the numbers say, beyond what the valuations say. Really take your time getting to know your potential buyer or seller. Again, treat it like a marriage. This is supposed to be a relationship that's going to last. So keeping in mind that cultural fit is the number one reason for a failure. That ties back to the objectives of the buyer and the seller. Again, you don't want to get married just for the sake of getting married. You want to make sure that it's somebody that you can continue to build each other up and complement each other through all facets of life. The same thing applies to your business. The deals that are most successful are those that take their time. They take the emotion out of it. They treat it in a very process-driven manner. And those that fail are those that are kind of looking for that quick hit. They're the Vegas-style weddings.
Very cool.
Yeah, I would just add to that. I mean, the deals that we like to do, that I would do day in and day out, would be junior buying senior. So, really the ones we love are going to be, son or daughter buying out, mom or dad. Those are really great transactions, right? Because the junior in most cases has been there working for a period of time, sometimes 5, 10, 15 years. They know all the clients, they know all the staff. They're clearly the succession plan. It's a very smooth transition. And then just to take the reverse side of that, the worst transactions that we see are going to be, people that are, across, are not location. One's in California, one's in Florida, and one is a fee-only RIA, and the other one is a life insurance salesman. So, I mean, two sort of extremes there, but we would do the junior buying senior almost every day of the week. So
that's great. That's great. So we only have a couple more minutes left here while people are kind of still noodling on their questions, and we still have just about everybody who started the podcast, the webinar, is still on, which is fantastic. And I almost mentioned podcast there, and that was going to be the point I made before we lose people. Truelytics does have a podcast. It's called the Valuations Podcast, and it has a new episode every week coming out. So please do head over to truelytics.com to check out that podcast. You can also find it on iTunes, Stitcher, and SoundCloud if that's your preference. Let's see. We do have a couple of other questions that came in earlier. One is, what is my first step if I want to get financing? So kind of what's the first thing I need to do if I'm thinking about going after a deal and getting financing for it?
Yeah, I think just having a conversation with me or one of our salespeople here at Live Oak. We do a lot of consultative work with people. Talk to them well before they're looking at an acquisition to sort of educate them and how to handle it or how to find sellers. So it's never too early to talk to somebody. And then when you're actually ready for financing, I typically say if the seller is willing to share their financials with you, then you're ready to start the loan application process. So definitely give us a call, never too early, but we'll set you up an application once you have some financials from the seller. That's
great. Okay. We'll give it one more minute or so before we get any see if there's any more questions, While we're waiting to see if anybody else puts any last minute questions in here, what are some of the best ways for people to follow up with you, James? How should they reach out to you?
Yeah, so my email address is james.hughes, that's HUGHES, @liveoak.bank. And you can email me there. I'm on LinkedIn. You can find me on LinkedIn. My phone number is 910-550-2295. And definitely encourage all of you to reach out.
Great. And how about yourself, Carla?
Sure. So you can get me through our truelytics.com website as well, or email carla@truelytics.com. And our number is, I was going to give out our 1-800 number, but let me give you out my direct number. It's 610-772-4278.
That's great. Okay. And I highly do encourage everybody to follow up if you have extra questions. What we will do after this webinar, just so you know, the webinar is recorded. it'll end up being posted on the Truelytics site, so you'll be able to see that and watch it. If there was some things we covered that you wanted to revisit, or if you wanted to share it with one of your partners. We'll also be probably packaging up some of the Q&A in print form here and finding a way to kind of put that together as well for you, because there's a lot of really good questions that came in over the course of this hour together. We have 2 more minutes. I will kind of leave the mic open. If anybody has any interesting conversation topics like, do you think the Red Sox will win the World Series now that they're up 2-0 on the Dodgers? That's really good to talk about. Or any other valuation and transaction related topics. Sorry, Carla, I know you're in Philly. Okay, great. We still have like I said, another minute or so. I got a question for the crowd, and we should have done this. We actually should have done a poll ahead of time. How many people here? You can drop this in the chat if you want. How many people here are considering being a buyer, and then how many are considered being a seller? So if you're considering buying, please kind of do a little hand wave there in the chat. If you're considering selling, maybe that's a good way too. And you can just, when you enter your chat, you can make it just for the organizer, so you don't have to tell the entire world. We'll take a look. It'd be kind of interesting to have a feel for, are you more interested as a potential acquirer or a potential of being acquired? Okay, one more. Okay, so I see, right now we're at a 50-50. I have 2 responses, a seller and a buyer. So I'm not sure if that is a representative sample size of everybody that was on the call. And maybe some people are a little more concerned with privacy or something, but I've got another seller coming in. And it's interesting. It did seem like most of the questions were buyer related, right? Thinking about the financing. But as you start to see people chime in that they're more interested in sellers, being a seller. And then I have somebody who's saying, send the sellers to me. This is great.
I was going to joke. It was only a matter of time before someone asked, hey, match me with
somebody's hunting in here. That's fantastic. I got another buyer. So look, it looks like there's a good mix of buyers and sellers, which is fantastic. And that's the way the market should be, right? And I think you happen to attend the right webinar, right? You have the firm that's able to help you with your succession plan, with your valuation, and to prepare yourself. And then you have the firm on the call that's able to help you with the financing to make sure that that deal actually ends up happening. And you can be one of those few and hard to find qualified buyers out there hunting. And as a seller, you can be prepared instead of just trying to put a finger in the wind and figure out how much is this business worth. So you'll know what your business is worth. Well, fantastic. Well, thank you everybody for attending. It really is an honor to have spent an hour with you. I know your time is valuable. It's always hard to carve an hour out of your busy workday. Thank you very much to Carla and to James. We really appreciate your time, your insights, and your wisdom they shared here. And I do urge everybody, follow up with Truelytics at truelytics.com, and also head over to liveoak.bank to follow up with the team over there. We hope to see you again and hear some questions coming in from you. All right, we'll talk to you soon. Thank you.